Hey, Mike Sandoval.
Mr. Jeff Silver, how are you?
I'm fantastic. Yourself?
I'm good. You're looking sharp.
Thank you. I'm getting older. That's for sure.
We all are.
Hey, I was just curious. You know, the market has been a bit slow over these past couple years, and you know, I believe it has a lot to do with the fact that sellers were reluctant to put their houses on the market. A lot to do with the fact that they probably have lower rates based on 2020 and 2021 rates being down in the 3s and below. I'm just curious, why do prices continue to rise in a slow market?
I mean, that is a very good question, Jeff. So what we're seeing is it all depends on supply and demand, right? So if we still have low supply because everybody's holding on to that 3% interest rate, you're not going to have a lot of sellers out there. So the demand is going to be still very consistent. Now we're seeing sellers deciding, hey, interest rates are not going to reach down to the 3s because I have a lot of sellers that say, I want to move to a bigger house, or I bought this house because this is the only house I was able to get, but it really doesn't fit my needs anymore. But if I move to the next home, it's going to be a lot more because obviously interest rates are going to be in the 6s or in the 7s or a lot more likely double than what they're paying now. So I said, okay, great. So what we're seeing today, though, with sellers is they are still putting their house on the market. They are putting a higher price for the house. We're not necessarily getting that price, and it's a very unique house. We're actually now seeing homes, Jeff, where comps are higher than the actual closed sale price. So we're actually seeing that adjustment happening. So to answer your question, yeah, we are seeing still sellers pricing their home as there were 2-3 years ago, but the market is not supporting that price. So we are seeing some appreciation in certain areas, but it has to be super unique or something, that is not a kind of a one of a kind type of home or unique property.
So let me get this right. So sellers now are coming into the market. They're deciding, okay, I'm going to get off the fence. I'm going to go. We got them. Our family's growing. Unfortunately, we're going to have to forego our 3%. We're going to have to take this 6 or 7% rate. So we're going to go ahead and make this move. But I want this price. Based on what I've seen the last couple years, I think I should be able to get this price. And yet, when they put their house on the market for that price, they're not selling.
That's right.
And would that be because there's a lot of people like them, and so there's more houses coming on the market now?
You nailed it. Absolutely. So we're starting to see that influx because they've reached a lot of sellers have reached that point, that threshold where I've grown out of this house. I can't be here anymore. And so they do forego that 3% or interest rate. But their mindset is, well, I bought this in a multiple bid market. It was a very good market. I should be able to do the same, but it's not the same anymore. And so you're absolutely right. We see a lot more inventory, a lot more sellers with a higher price, but they're not getting that number.
Gotcha. Okay. Well, it sounds to me like good advice for a seller then would be to not look at past sales, but look at when those houses closed escrow, what did they list at?
Right.
And maybe that might be a better indicator as to what they might be able to sell today, assuming the market is flat or even going down a little bit in some neighborhoods.
I look at the pending sales. The pending sales is where the market is today. The solds are the past. The pending sales is the current, and the actives are what they want in the future as far as value. So yeah, pending sales are critical to knowing a market, and especially in this kind of a market that we're in today.
Oh, that's great advice, Mike. So all you sellers out there, price it right.
That's right. Thank you, Jeff. I appreciate that.
Yeah. You have a great day, Mike.
Thank you too.
Bye.